Before starting this video, I want to suggest you guys that learning and hard working are the keys of success, so if you to be a part of our family, so do follow and subscribe our channel. So let's get started. So first tip is 1. Do not take up hot tips about stock market. It's generally not a good idea to act on hot tips or insider information when it comes to investing in the stock market. This is because these types of tips can often be unreliable or even fraudulent. In addition, acting on insider information is illegal in many countries. Instead of relying on hot tips, it's important to do your own research and due diligence when it comes to selecting stocks for your portfolio. 2. Don't sweat much for little money. It's important to keep things in perspective when it comes to investing. While it's natural to want to make as much money as possible, it's also important to consider the amount of risk you are taking on and to only invest money that you can afford to lose. If you are investing a small amount of money, it may not be worth it to spend a lot of time and energy worrying about every little move in the market. Instead, focus on developing a long-term investment strategy that aligns with your financial goals and risk tolerance. Diversifying your portfolio and investing for the long term can help to reduce risk and increase your chances of success. 3. Don't overemphasize the PE ratio. The price to earnings (PE) ratio is a popular metric used to evaluate the relative value of a company's stock. It is calculated by dividing the price of a stock by the company's earnings per share, EPS. A high PE ratio can indicate that the market is willing to pay a higher price for the company's earnings, while a low PE ratio may suggest that the market is not as optimistic about the company's future prospects. While the PE ratio can be a useful tool for evaluating a stock, it's important not to overemphasize it or rely on it too heavily when making investment decisions. 4. Pick a strategy and stick with it. Developing and sticking with a well-thought-out investment strategy can be key to achieving long-term success in the stock market. This might involve setting specific financial goals, determining your risk tolerance, and choosing an appropriate asset allocation. Once you have a plan in place, it's important to stick with it and resist the temptation to make rash decisions based on short-term market fluctuations. This can be easier said than done, as it can be tempting to make impulsive trades or to try to chase after the latest hot stock. However, these types of behaviors can often lead to poor investment outcomes. 5. Focus on the future. Last but not least, it's a very important topic to keep in mind. When it comes to investing in the stock market, it's important to focus on the long term rather than trying to chase short-term gains. This means looking beyond the current market conditions and considering the future potential of a company or industry. To do this, you can research a company's financial health, management team, and industry outlook. You can also consider its competitive advantages and any potential risks or challenges it may face. By looking at the big picture, you can make more informed decisions about which stocks to include in your portfolio. It's also a good idea to diversify your portfolio and invest in a range of different stocks and other asset classes. This can help to reduce risk and increase your chances of success over the long term. Remember to keep your investment goals in mind and stay focused on the future when making investment decisions.